The global financial system is sitting on a powder keg. But I'm not talking about crypto. This is about the bond market, the bedrock of our financial world. Specifically, the multi-trillion-dollar maturity wall of corporate debt looming over us. Tonight, we'll look past the stock market headlines and dive into the real crisis. The bond market's flashing red warnings. This isn't just Wall Street's problem. It affects your pension, your mortgage, your job, and your savings. The cracks are spreading, and we're going to break down 5 critical reasons why the bond market could trigger the next financial earthquake. Stick with me. What you learned tonight could change how you think about your money. First warning: rising yields. For years, central banks kept interest rates near zero, fueling a bond bubble. Investors piled into low-yield bonds, but now, with inflation surging, central banks have slammed on the brakes and hiked rates. When new higher-yield bonds hit the market, the value of old, low-yield bonds collapses. Pension funds, banks, and even foreign governments are sitting on massive paper losses. The Federal Reserve, once the buyer of last resort, is now selling bonds, creating a vacuum of demand. Foreign buyers like China and Japan are pulling back. The U.S. Treasury must sell trillions in new debt, but the usual buyers are gone. To attract anyone, yields must rise even higher. Higher government bond yields push up rates on everything: mortgages, car loans, credit cards. The losses are staggering, trillions wiped from balance sheets. Silicon Valley Bank's collapse was just a preview. Now, this dynamic is playing out globally, threatening banks and retirement funds everywhere. The bond market's foundation is crumbling, and the death of demand is the first domino. This isn't just a Wall Street problem, it's Main Street's crisis too. The institutions holding your savings are underwater. The world's safest asset is suddenly anything but. The first warning is clear: the system is breaking. Second warning: the corporate debt maturity wall. For over a decade, companies binged on cheap debt, trillions borrowed at rock-bottom rates. But that debt comes due soon, and most companies don't pay it back, they refinance. Now, refinancing means facing much higher interest rates. For weaker companies, this is a death sentence. Interest payments triple or quadruple overnight. Zombie companies, those barely covering interest, will collapse as cheap debt disappears. Even healthy firms will cut investment and jobs to cope with soaring costs. The maturity wall is a tidal wave. Trillions in corporate debt must be rolled over in the next 2 years. Lending standards have dropped. So much of this debt is junk, risky, leveraged loans. When these companies try to refinance, they may find no lenders willing to take the risk. This is how a credit crunch starts. Thousands of companies will rush to refinance at once, but banks are getting cautious. It's a cliff, not a gentle slope. The era of debt-fueled growth is over, and the hangover will be brutal. The maturity wall threatens jobs, investment, and economic stability. The bill for a decade of easy money is coming due, and it's much bigger than anyone expected. Third warning: extreme volatility and evaporating liquidity. Liquidity means how easily you can buy or sell without moving the price. Right now, the bond market is dangerously shallow and volatile. The MOVE index, the bond market's fear gauge, is spiking to crisis levels. Big banks, the main market makers, are backing away, shrinking inventories, and refusing risk. This creates a feedback loop. Less liquidity means more volatility, which means even less liquidity. We're one shock away from a market freeze, where you can't sell at any price. In March 2020, the U.S. Treasury market broke. Only a massive Fed intervention saved it. Today, the same conditions are back. If the U.S. bond market freezes, the global financial system seizes up. Credit stops, banks stop lending, and the economy grinds to a halt. Hedge funds are making huge, risky bets, adding to the chaos. Foreign central banks are unpredictable, further destabilizing the market. The U.S. Treasury is trying to sell record debt into a broken market. The system is rejecting the debt, and wild price swings are the symptoms. The bond market is now a casino, not a safe haven. The fire alarm is blaring. Evaporating liquidity is the silence before the storm. The foundation is brittle and primed to shatter. The next shock could be catastrophic. Fourth warning: fiscal recklessness and eroding global trust. The U.S. has long enjoyed the exorbitant privilege of the world's reserve currency, but that trust is fading. Trillion-dollar deficits are now routine, even in good times. The government is flooding the market with new debt just as demand is drying up. Basic economics, too much supply, not enough buyers, yields skyrocket. Foreign buyers like China and Japan are stepping back, wary of U.S. financial weaponization and rising geopolitical tensions. De-dollarization is underway. Countries are diversifying away from U.S. treasuries. The US is left to absorb its own debt, fueling inflation and risking a debt spiral. Credit rating agencies are downgrading US debt, citing deficits and dysfunction. The risk of a technical default is low, but inflationary default, paying back with devalued dollars, is real. Both political parties have contributed to this fiscal mess. Interest payments on the national debt are soaring, soon to surpass defense spending. We're borrowing to pay interest on what we've already borrowed, a classic debt spiral. Global faith in US fiscal responsibility is collapsing. Without that trust, treasuries are just another risky asset. The exorbitant privilege is fading fast. As trust erodes, borrowing costs for everyone will rise. The world is watching and losing confidence. The consequences will be felt in every corner of the economy. Fiscal recklessness is the slow-burning fuse to a global explosion. Fifth warning: systemic risk and the domino effect. The bond market is the central nervous system of the global economy. When it fails, everything else follows. First domino: government bond yields spike, making borrowing expensive and volatile. Second, corporate borrowing costs explode, defaults and bankruptcies surge, and the economy slows. Third, banks crack under the pressure. Unrealized bond losses and loan defaults hit balance sheets hard. Regional banks are especially vulnerable, exposed to both interest rate risk and bad loans. Fourth, sovereign debt crises erupt worldwide as countries struggle with rising rates and unsustainable debts. Even major economies like Italy or Japan could be at risk. Fifth, central banks panic, slashing rates and launching massive QE to bail out the system. But with inflation still high, this solution could trigger a second, even worse wave of inflation. Central banks are trapped. Save the system or save the currency. The likely outcome: stagflation, stagnant growth, and high inflation. This isn't doomsday talk. It's the logical result of the path we're on. Each warning is a domino already wobbling. When they fall, the chain reaction will be nearly unstoppable. The explosion in the bond market will ripple through every part of your life: prices, jobs, savings, and stability. The dominoes are lined up, and the first is already tipping. The time to prepare is now. 5 clear warnings. The bond market is flashing red. This isn't a single failure, it's a systemic crisis brewing beneath the surface. The goal isn't fear, it's preparation. Understanding these risks is the first step to protecting your finances. When the risk-free asset becomes the epicenter of risk, you must rethink everything. The coming years will be volatile, but knowledge is your best defense. Stay informed, stay prepared, and stay safe.